If you are using loans or line of credits to grow your business, the Big Beautiful Tax Bill just gave you one of the best tax breaks in years. Under the 2025 updates, you can deduct more of your interest, keep more cash in your pocket, and finally breathe a little easier about financing your growth. Here, what this means for you. So Section 163J, the rules that limit how much business interest you can deduct, just got friendlier. For years, the IRS capped the business interest deduction at 30% of adjusted taxable income. But that income figure was based on EBITDA, which include depreciation and amortization. So that cut down your deduction and hits capital-intensive business the hardest. Now, starting in tax year 2025, that same 30% limit is calculated on an EBITDA basis. So earning before interest, taxes, depreciation, and amortization. So this one increase your deduction potential immediately because the depreciation and amortization no longer shrink your base. And if your business is averaging 31 million or less in gross receipts, you are fully exempt from this rule. So that threshold was raised under the Big Beautiful Tax Bill. So many small and mid-sized businesses will qualify. This isn't just for big corporations. It's for you if you are financing growth, so think about it. If you are buying a new work vehicles, invest in machinery, expanding your space, or managing a credit line to keep cash flow moving. So this update gives you more tax breathing room. The more strategic you are with debt, the more you can turn it into a deduction engine. Let me give you a real example. One of my clients, Greenco Roofing in Charlotte, North Carolina, came to me last summer. They are a family-owned, about 18 employees, doing roughly 28 million in annual receipts. They took out $500K equipment loan to expand their service area with about $120K of interest expected in 2025. Under the new EBITDA-based limit, they might have lost the portion of that deduction. But because of the new law, raised the exemption threshold and brought back the EBITDA basis, they qualify for the small business exemption. That means they get to deduct 100% of the interest. The result, 25K tax saving. They can reinvest straight to payroll and new contracts. Another client, Sunset Retailers LLC out of Phoenix, runs several home goods stores with 45 million in receipts, too large for the exemption. Their interest expense were $750K for 2025. When we calculate their AET under the new EBITDA formula, it came out to be 2.8 million. 30% of that is 840K, which covers their entire interest cost. They get to deduct every dollar. If the own EBIT limit was still in play, they would have lost about 80K of that deduction. This one adjustment saved them roughly 16K in taxes. Now let's talk about Seaside Developers Inc. in Miami, a real estate company with 120 million in receipts. They build commercial projects and rely on construction loans. Their CFO asked if they could elect the real property trade or business opt out to avoid 163J altogether. We modeled both options. If they elected out, they would have to use the ADS depreciation method and give up bonus depreciation on certain property classes. By staying in 163J under EBITDA rule, they got to keep 100% bonus depreciation on new projects while still deducting most of their interest. In their case, staying in produced bigger overall write-up. The lesson is clear. They can't assume electing out is always better. You have to model it and see where you win. So, what should you be doing now while preparing your 2025 return? Start it by checking your average gross receipts. If you are under 31 million, you are exempt. But document that calculation carefully because the IRS looks at a 3-year average and aggregates related entities. If you are close to that number, monitor your growth because one big contract would push you over the line next year. Next, project your adjusted taxable income on the EBITDA basis. Multiply that number by 30% to get your limit. Compare it to your interest expense. If you are under, great. If you are over, plan how you would use those carry forwards because the disallowed interest now carry forward indefinitely. Now is also the time to coordinate interest with depreciation. Since depreciation and amortization don't reduce ATI anymore, you can pair large equipment purchases with financing and still preserve your full interest deduction. That's a powerful planning move. You can use bonus depreciation or the new 168N expensing and still get your full interest deduction, something that wasn't always possible before. Keep your books clean. Separate business and personal debt. Make sure your interest tracing is clear. If you are using one credit line for mixed purposes, break it out so the business portion stays deductible. And make sure you are checking any disallowed interest on Form 8990. It carries forward and you don't want those amounts getting lost in your records. Heading into 2026, there's another layer to watch. Starting with tax year after 2025, 163J will apply even to capitalized interest. Interest you would normally roll into the cost of building or producing an asset. That means if you are a builder or a manufacturer, your limit could tighten in 2026 if you don't plan early. So structure your loans with that in mind. If you expect major financing projects next year, model your capitalization and deduction schedule now. Foreign-owned or multinational businesses should pay attention too. New coordination rules will exclude certain foreign income inclusion from ATI, which can shrink your deduction base. If you have CFCs or GILTI income, it's worth reviewing your structure before 2026 starts. Here, what I recommend for anyone watching. Run your 22 to 24 receipts, estimate your 2025 interest expense, and calculate your EBITDA based ATI. If you are exempt, enjoy that win, but keep monitoring it each year. If you are not exempt, use the 30% limit to model your carries forward and bonus depreciation timing. For real estate businesses, stimulate both staying in and electing out before you file. Don't decide after the fact. There are a few advanced tips that can make a big difference. Stagger when you play asset and service so your interest and depreciation align with income. If interest rate drop in 2026, consider refinancing, but compare the cash flow savings to the loss deduction. Keep your loan documentation ready because IRS examiner often asks for proof that debt is business related. And if you operate multiple entities, remember the aggregation rules. Splitting companies won't help if common ownership ties them back together. Let's recap the essentials. The Big Beautiful Tax Bill makes Section 163J more generous by restoring EBITDA basis and lifting small business exemption to around $31 million in 2025. Any disallowed interest carries forward indefinitely. Real property businesses can still elect out, but that election is permanent and comes with depreciation trade-offs. And new coordination rules starting 2026 mean you need to think ahead about capitalized interest and foreign income adjustment. If you take anything away from this, it's this. You can borrow smarter and deduct more if you plan ahead. Calculate your exemption, model your limits, coordinate with depreciation, and document everything. With the Big Beautiful Tax Bill 2025 is your chance to make leverage work in your favor. Thank you for watching. I'm Nia. I will see you at the next update.